If you tried to trade silver last Thursday night, you saw something terrifying. Nothing. Welcome to silver's cooling failure cover-up, the London Loophole, the glitch, and why the CME went dark. For 11 agonizing hours, the CME Group, the world's largest derivatives exchange, went dark. Gold, oil, treasury bonds, and crucially silver, all frozen. The official story will tell you it was a cooling system failure at the Cyrus 1 data center in Chicago. Maybe that's true, but in our 20 years in this business, we've learned that there's no coincidences when money this big is on the line. Because the moment the screens flickered back on Friday morning, silver violently repriced to a new all-time high above $55. The reaction was a story. The system blinked, and when it opened its eyes, the truth was staring it right in the face. We are witnessing a market that's primed to break on contact. The paper market's glitching because the physical reality underneath is shifting it tectonically. Here's what's happening. The China drain is real. While Western traders were staring at blank screens in Chicago, the real alarm bells were ringing in Shanghai well before that. For the last year, we've tracked a massive migration of physical metal from west to east, but that flow reached a critical breaking point. Shanghai silver inventories have just collapsed to decade lows. Look at this chart. It's arguably the most important graphic in the commodities market right now. The supply squeeze in China keeps tightening. This is critical because China is the epicenter of industrial demand. When their warehouses go empty, they don't just stop buying, they bid, and they bid high. Now you might have seen a conflicting headline recently. The London Bullion Market Association, LBMA, reported that London silver vaults actually rose by 6.8% in October to just under 27,000 tons. The bears cheered. See, they said, there's plenty of silver. But they're wrong. That inflow isn't new mining supply. It's a reversal of the London squeeze, where earlier tightness forced metal onto COMEX to plug holes, creating distortions. That metal was shuffled around to give the market breathing room. But it's not relief. It's a shell game, and the shells are running out. The team that found Mag Silver's deposits is back, and history could rhyme again. Greg Liller and Alex Langer are working on what they see as a prime Mexican silver belt. They just brought the Coloso mine into production, and the grades explain why this matters. Coloso runs 221 grams per ton silver, nearly double Guitarra's 123 grams per ton. When you blend higher grade ore into the mill, everything changes. Processing costs stay flat, but revenue per ton jumps 80%. That's how mining math creates leverage. Sierra Madre Gold and Silver trades as SM in Canada and SMDRF in the US. The London Loophole is closing. While the computers were down in Chicago, the real panic was happening 4,000 miles away in London. The London Bullion Market Association vaults, which is the physical backstop for entire global silver trade, are running on fumes. We're seeing reports that silver lease rates, the cost to borrow physical metal, have spiked. It looked like a dead heartbeat through 2024, barely above zero. They finally twitched in early 2025, staying under 2% until June, then it erupted to 35% in October. The spike cooled, but the pulse is rising again and pushing back towards 6%. In plain English, there's no metal left. The bullion banks are desperate. They're scrambling to find bars to deliver against paper contracts. And for the first time in history, the physical owners aren't selling, they're hoarding. The Electro dollar age and the AI energy vortex. So why is the metal disappearing? Easy. The Electro dollar age and the AI energy vortex. It's not just coins and bullion stackers, it's a new, voracious beast we call the AI energy complex. You already know about the solar boom, but here's what the mainstream financial press missed. AI servers use significantly more silver than traditional servers. According to data circulating from the Silver Institute and Shanghai Metals Market, AI servers require 2 to 3 times more silver than standard servers due to high power density and complex cooling connectors. Every time big tech builds a new data center, they're locking away millions of ounces of silver into circuit boards and high performance connectors. We're in the 5th consecutive year of a structural deficit. Demand from exploding solar AI and EVs. Supply? It's flat. mine production is stagnant between 810 million and 830 million ounces. And the inventory? It's critical. Like we said, London is empty. Silver can't bank on the bank's forecast. Earlier this year, the biggest banks on Wall Street told you to stay away. JP Morgan predicted silver would average just $36 in 2025. And HSBC had to scramble in October to raise their forecast to $44.50 for 2026. They missed the fundamental shift. They looked at silver as just a monetary metal that moves with interest rates. They forgot that it's the indispensable metal of the digital age. You cannot have ChatGPT, solar farms, or EV batteries without silver. That CME glitch was a warning shot. We smashed through the psychological $50 barrier. 55 plus is the new reality, and the ceiling just became unlimited. Not to mention, the technicals in this market are starting to look incredibly sexy. The glitch was a system blinking. The data shows the plumbing is under maximum stress. In this month's Katusa's Resource Opportunities, our premium newsletter, we detail exactly how to position your portfolio for the Electro dollar age, including the specific equities and stocks that will benefit most from the China drain. Learn how to become a member in the link below, and stay tuned for the next video.